Dick Smith Electronics have been in the news lately because they've had financial troubles and gone into administration. And one of the stories out at the moment is how there's thousands of gift vouchers that were bought for people from Dick Smith's before Christmas as gifts to their family and friends. And the problem now is with Dick Smith's going into administration in early January 2016, the customers with those gift vouchers now can't use them. But how come? The stores are all still open, so why can't a customer go into the shop and use their gift voucher? Anyone else can go in with money or a credit card and go and buy anything from Dick Smith's now. So why can't you go in if you've got a voucher? Well, it all comes down to the accounting treatment of a gift voucher. So what we need to remember is that there's a little bit of a difference between a regular sale. So we deal with this in accounting. So we have a customer in a business. A business buys stock, so say a pair of shoes for $40, and then they'll sell it for another price, so let's say $100, and then a customer gives the business some money, so if we add 10% GST to that $100, that's $110, and the two parties swap. So for the business, that sale is really easy to record. We've got cash, which is a debit going up, that's an asset increasing. We receive some GST, so that increases our liability, and we have a sale, which is a revenue of $100. What we also need to do though is when we make a sale, we need to account for the cost of sale. So to make that sale of $100 plus GST, we had to have a cost of sale of $40, which is an expense going up, and we had to decrease the amount of stock that we owned. So we did a credit to stock control. So that's pretty straightforward, but that is not a gift voucher. What happens with a gift voucher is it's a friend or family member of the customer is actually the one who came in and let's say gave Dick Smith or any business the $110, and they walked away with a gift voucher to give to their friend. So for Dick Smith, that's a little bit different. So in Unit 4 accounting, we deal with an item called prepaid revenues. And a gift voucher is actually going to represent a prepaid revenue. So what does that mean? Well, it means the business still has $110. We don't record any GST at the time of getting the money. What we do though is we say that whole $110 is a special type of liability called a prepaid revenue. And because there's no transaction of goods here, the person who bought the gift voucher doesn't leave with any goods, there's not going to be a cost of sale. So no revenue has actually been earned yet, so that's why we haven't recorded a sale. We've recorded a prepaid sale or prepaid revenue. So the customer doesn't, or the friend of the customer doesn't walk out with the shoes. The shoes are still at the business. So when you think about it, the business has everything. They've got the money and they've still got the stock. So therefore, no revenue's been earned. So what we did is we called prepaid revenue, and a gift voucher would meet that definition. We called it a liability, and that's because the money's been received but not yet earned. And therefore, if we go through our definition of a liability, it's going to meet the three parts. So this is a liability because, one, there's a present obligation. So what's Dick Smith's obliged to do? They're obliged to provide $110 of goods to the customer who brings in the gift voucher. It's arising from a past event. So in this case, the friend went in before Christmas and bought a $110 gift voucher. And there will be an outflow of future economic benefits. When the customer finally comes in to use their gift voucher, they'll walk away with some goods, and we've sacrificed some economic benefits. So clearly that is a liability. And in the balance sheet for Dick Smith, it's going to sit in there with all its other liabilities. So it might have creditors control, loans, accrued wages, taxes, and down the bottom we might have prepaid revenue, or we've got another name for saying gift vouchers. So still, we haven't answered why can't I go and use my gift voucher? Well, it's all because the rules of administration are really particular. What they say is when we go into administration, we get a list of our liabilities and we have to pay them off in a certain order. And there's what's called a secured liability first. And what that means is certain liabilities have got to be paid first. So in Dick Smith's case, the actual order of payment when you're in administration is you first of all got to pay off your loans to the bank. Now they've got $71 million of loans outstanding, so they need to pay that off first. So once they've done that, they can move to the next liability to pay off. In administration, that becomes creditors, so it could be suppliers of their stock. They owe $228 million to those people, so that once they're all paid off, they can go and pay the next liability, which in this case was probably their employees. There might be $10 million of outstanding wages for the month that haven't been paid. Once that's been paid, move to the next liability. We've got to make sure our taxes are paid with the government. Now for Dick Smith, they actually don't have any tax liabilities, so they're okay there, so that's easy. And now finally, once all those have been paid, if there's any money left over, people can go and claim their gift vouchers. So it's not that you can't necessarily use the gift voucher ever, it's just that for Dick Smiths, they're going to have to make sure all these other liabilities are paid off during administration first. Once they are, they might come out and announce you can now come in and use your gift vouchers. Of course, for the people who own gift vouchers, there's not a guarantee that'll happen. They might go broke and you'll never get to use your gift voucher. So looking at some questions, how are regular sales treated different to gift vouchers? So in Unit 4 accounting, we do prepaid revenue and how that's different to regular revenue. Why is a gift voucher a liability to a business? So we call it a prepaid revenue. Why? How come it meets that criteria? And why can't Dick Smiths honour gift vouchers now while the business is in administration? Is that just that they don't want to, or is there a certain rule that they have to follow during the administration period?